Hi, I'm Jay Prakash. Welcome again to our series on smarter fixed income investing with bonds. Ever heard the word bond and thought, it's too complex? Let's fix that. By the end of this video, you'll understand bonds better than most investors. So what's a bond, really? As we discussed in the previous episode, a bond is essentially a loan you give to a company or the government. They promise to pay you interest regularly and return your money either at maturity or across the bond's life. Let's say you buy a bond. What are you getting? When you buy a bond, here are two key things to know. Face value. That's the base amount you are paying for one bond from a borrower. Let us just say that 1,000 rupees, and that is what you will get back as principal. Coupon rate. That's the interest paid annually on that face value. A 6% coupon on 1,000 rupees would mean you get 60 rupees every year. Simple, right? Now the coupon rate tells you the annual interest you'll earn on the face value of the bond. Useful, but not the full picture. The yield to maturity, YTM, is what really matters. It shows your actual annualized return if you hold the bond till maturity. So why is the difference? Yield to maturity factors in the price you paid, which may be above or below the face value, the interest payments, which is the coupon you'll receive, and the time until you get your full principal back. Here is the key. Buy at a discount, your YTM is higher than the coupon. Buy at a premium, your YTM is lower than the coupon. So always compare bonds using YTM, not just the coupon rate. It reflects the true earning potential of a bond. So what determines the price you pay for a bond? You might see terms like face value, clean price, dirty price, accrued interest. Let's break them down. The face value is fixed by the issuer, usually 1,000 rupees, 10,000 rupees or 1 lakh. And that's the amount you'll get back at maturity or at different periods of time. But the price you pay today can be higher, lower or equal to the face value. Why? Several factors. Face value, as told before, is the amount you'll get back at maturity, typically 1,000, 10,000, etc. Premium or discount. This is where the bonds could trade at a premium, which is above the face value, or at a discount below the face value, based on interest rates, creditworthiness, investor appetite, lot of factors. Accrued interest. If you buy the bond in the middle of an interest cycle, you'll pay the seller for the interest they've already earned, and that is the accrued interest. Clean price means the price of the bond itself, excluding any accrued interest. And finally, the dirty price means the total amount you pay for the bond, which is the clean price, plus the accrued interest. Sometimes in unusual cases, accrued interest can be negative. For instance, if you buy after the record date, but before the interest payment. Let us do it with an example. Let us assume bond has a coupon rate of 12% and as a face value of the bond is say 1,000 rupees. An accrued interest of 42 rupees on the bond, which means it will be trading at 1,000 rupees 42 per bond. Here the clean price is 1,000, which is the face value, and the dirty price is 1,000 rupees 42, which is including the accrued interest. In this case, your yield to maturity will be slightly lower than the coupon rate of 12%. Next thing that you have to think about when choosing a bond is tenure. Short-term bonds, typically about 1 to 3 years, carry lower returns but also carry lower risk. Long-term bonds, which are like 5+ years, would carry higher returns but more affected by the interest rate changes. It's important that you pick what aligns with your financial goals and risk appetite. Next important feature while picking a bond is credit rating. Every bond comes with a credit rating which reflects how likely the borrower is to repay. Here is a quick guide. AAA rated bonds are the safest. BBB minus and above are investment grade bonds, with BBB minus being the highest risk to AAA, which is the lowest risk. Bonds that are rated BB and below are called junk bonds. and bonds that are rated D are already at default. Higher risk usually means higher returns, but make sure you understand what you're trading off. Now let's talk about security. Secured bonds are backed by company assets like property or receivables. Unsecured bonds have no security, which means there is no specific collateral attached to the bond. Senior bonds would mean that you get paid before other investors if something goes wrong with the borrower. Subordinated bonds would mean that you are lower in the priority in case of a default. These details matter, especially in case of credit events. Some bonds come with built-in options, which affect your flexibility. Let's say callable bonds. This would mean that the issuer can repay early, not ideal for you if interest rates drop. Puttable bonds, which means that you can exit early, great if you want more control or flexibility. Always check these before investing, they can impact your returns and exit strategy. So how is a bond taxed? Most bonds are taxable. Interest adds to your income and you would pay as per your income tax slab. And then there is tax-free bonds, often PSU issued. These offer lower returns, but the interest income is tax-free. Before you invest, be aware of some of the key risks. They are not complex, but they do matter. Credit risk, which evaluates whether the ability of the borrower to repay you on time. Interest rate risk, when interest rates go up, bond prices go down. Liquidity risk, where not all bonds are easy to sell when you want to exit. And the reinvestment risk, can you reinvest your interest payments at the same rate? Understanding these risks help you make smarter, more confident choices. Now that we have covered different terms, let us summarize with a quick checklist. If the yield to maturity or YTM is greater than coupon, you are getting a better deal. Credit rating indicates safety and risks. Maturity, which should match with your financial goals. Secured, unsecured, senior, it talks about the repayment protection you have on your bond. Payout frequency helps manage your cash flows. Callable or puttable provides you flexibility. 10. What is your post-tax returns? Keep this list handy whenever you are evaluating a bond. So how can you get started? It's simple. You don't need 10 lakhs to start. Even with 10,000, a well-chosen bond can give you monthly income, beat your FD returns, and bring stability to your investment portfolio. So don't just save, grow smartly. Thanks for watching, and we'll see you in the next episode.